How's it going on, y'all? Welcome back to the channel, Quiz Trades. Happy Monday. Today's October 6th. I hope y'all had a good weekend. Today I have another fundamentals video for you guys, part 3 of this series. Today I'm going to break it down in two different categories. The first category is going to be market truths. So this includes candle formations, IRL to ERL, and market maker models. And then the second section is going to be just confluences I use that I have not included in the model particularly, but they're still very important confluences that could better the way you trade. So we're going to first start with candle formations. Now there's two types of candle formations. The first one is an open, high, low, close. And then the second one, we get a reversal based off of what the bias is. And what that means is if I, hold on. This, oh, nice. I didn't know I could do that. So the first one is, as I said, an open, high, low, close, right? So we close in the midst, and it goes both ways. You could go open, low, high, close. These are two types of candle formations. They're both the same in the same pair, but just depends if you're bullish or biased. And what this means is, or how this works. And when I say candle formations, this happens on every single time frame. So the 1 hour candle does it. I mean, you can see right here, right? We open here. This is literally just a random candle. We open here. We then put in this high. We then come down, and we close in the midst. So if I were to go to like the 15-minute time frame, what you'd see is you'd see candles. Let me get back to this. You'd see candles going bullish, sweeping a liquidity, tapping into a PD array. Then you'd see us trading down, and then you'd see us fulfilling whatever liquidity we came down for, and then we close more in the middle, right? So this is what it looked like: open, high, low, close, and this formation creates a candle that looks like this. Okay. And why that is important is if this happens on every single time frame, that means it happens on the weekly, the daily, the 4 hour. And what this means is if you know how a candle is going to form, you can catch the top and bottom. So if we know that a candle is going to form open, high, low, close on the week, that's what the weekly candle is going to look like. What we wait for is one, at the high and low, where and when are we sweeping liquidity, right? Because that's what causes us to go from a high to a low, is we're sweeping liquidity and tapping into a PD array, right? And that ties in perfectly with the second truth of the candles and market is market always goes from IRL to ERL and ERL to IRL. So pairing this up, right? If we have a previous week high, or we'll actually say previous week low, because we've been bullish, I'm going to keep most of the examples bullish. If we have a previous week low right here, okay, and we're trading, it's Monday, all right, so let's just say we have previous week high up here, and we have previous week low up here, and it's Monday, and we open around, we open around here, we then trade bearish, right? What the fuck? There we go. We trade bearish Monday, and we sweep this, right? We get this liquidity sweep right here. Bro, why would you do that? It's actually kind of fun. This is the first time I've like done this drawing, shown this. So we get this liquidity sweep, right? We tap into, let's say, a bullish PD array, a bullish 4 hour or daily order block or fair value gap. We are now going from IRL, right? This would be IRL because we're sweeping a low and we're tapping to a high time frame bullish gap. So we're going from IRL, we're targeting what? Our previous week high. This is basically the main format and structure of the model. So when we're going open, low, we know that the truth of the candle is it's going to go high close, meaning we're then, hello, where'd the brush go? Am I tripping? Oh, there we go. We're then gonna trade up. keep this color. We're gonna trade up, bruh. Oh my God. We're gonna trade up and into our previous week high, okay? And then we're gonna close somewhere in the midst. What this means is, right, a couple things. First, by us sweeping liquidity and tapping into this PD array, we are fulfilling two parts of the model. This looks like ass looking at it, I can't lie, but stay with me. We're fulfilling two parts of the model, right? The third part is this IRL level and this liquidity sweep would need to be in equilibrium of whatever range we're looking at. Because this is a weekly trade, we'd be looking at the previous week range. So like the high, all-time high from here, and then like a 2-week low range, which if you watch my last video, which is getting uploaded like right now, it's a trade recap. I mentioned that one thing I learned and started implementing into my trades is when we're marking out equilibrium levels, when we're all-time high cycling, to get a more accurate low, or to get a more accurate level of equilibrium, you should, instead of just pulling it out off this weekly range, which is usually what you do when price can go either way, but when we're all-time high cycling, it's more accurate to pull it from the past 2-week low range, right? So this week, instead of just pulling it to the last week range, because then you get thrown off, right? Because Wednesday, pull into equilibrium, bullish gap, this, that, and the third. When you pull it from a 2-week range, then there's only one day that actually pulls into equilibrium. But watch my last video and that'll make more sense. So, as I was saying, when we go get our liquidity sweep, PD array, and we're in IRL, we know using these two truths that market goes from IRL to ERL, and the truth that we always form an open, high, low close, or the other, I'll get into the other formation of candle, but let's just say here we're assuming we're going from an open, low, high close week because of which day fulfilled the model. So you have to pair this up, right? Knowing that, okay, we're going to get this based off a certain time, meaning day, by refunction time as day, as you would with like New York Open or 4-hour candle like this. We're currently functioning time as our day. So if Monday comes down, puts in a low where we sweep liquidity, we're in IRL, we fulfill equilibrium. What are we waiting for? We're waiting for a change in state, which is closing through whatever up close candle we had before getting that bearish liquidity, or like that sell side liquidity sweep. Once we close through it, now we know we're targeting ERL, which is up here. You know, this looks like shit. So this is the part of the market that we want to trade, right? Yes, you can trade this manipulation leg, right? Yes, you can trade down here, I guess, whatever. What's best is to either wait for the change in state or trade off liquidity. But the main part that you want to trade is this distribution leg back up to ERL. Okay, so how this would look for the most part is this would be like a Monday, or this could be a Monday, and then Tuesday could be the manipulation day, and then this could be Wednesday, Thursday. Thursday puts in a high week, and then Friday comes and closes back in the midst of the distribution leg. That's one way, right? That's one candle formation. The second candle formation is, or not really candle formation, but the second way is we get that high placed midweek, right? So if we go back to my first, like the first QMT model I wrote, we have our open, high, low, close week, and then we have our midweek reversal, which happens quite a lot, right? It happened last week. We had our midweek reversal, which means I will be putting the established low on a Wednesday. As you can see right here, we put our established low on this Wednesday. We take out both Monday high and low. So yes, the candle will still look like an open, high, low, close week, as you can see. Open, low, high, close week. But when you put it in terms of how accurate you want it to be based off of time, then the only way you can catch the open, high, low, close week is Monday, Tuesday. Otherwise, it will be a midweek reversal. So again, it's pretty similar to the model is the same. Okay, we have our low right here. We have sell side right here. Candle, or like Monday, even if Monday is pretty high up, so we'll have previous week low or like a established daily low there, and then we have previous week high. When you're really bullish, it's more rare that we're going to take out previous week low to go to previous week high. We'll most likely just sweep like a daily low. So let's say we actually closed up here, so Monday can trade. However, Monday can actually put in a secondary high as a draw on liquidity, so something like this, and then we could have Tuesday trade Barrett. What the fuck is happening? Hold on. Delete all that. So we could have Monday trade bullish, Tuesday then trade bearish as well, and then Wednesday trade lower. This will then get our liquidity sweep of a previous week day low, so a day in the previous week, and we're sweeping Tuesday low. So let's say Tuesday left a nice low like this. Wednesday will sweep that low. Wednesday will sweep this low. We'll then get our change in state, closing back through an up move candle before the down close. And then from there, we'll distribute Wednesday, Thursday, sweep previous week low, and then Friday will close somewhere in that range. Or Friday can continue higher, it just depends. The main thing is you must make sure that this liquidity sweep is paired up with a PD array and we're in equilibrium of the range. This is the same. We're still going from IRL to ERL. And again, the concept of market going IRL to ERL and ERL to IRL works both ways. So, or like, for example, my trade recap or the trade I took today was an ERL to IRL trade. Why is this an ERL to IRL trade? Because we swept previous day high, right? And because we swept previous day high, which was all-time high, we're at ERL, okay? And because we're bullish on the high time frame, if we're sweeping buy side, then we're gonna go bearish to find IRL, okay? Because what you must understand is ERL, depending on the bias, ERL, if we're bullish, ERL is higher than IRL. I don't know why I did that fucking line. So this would be ERL, right? ERL highs would be here, and IRL PD arrays would be down here. Okay, so now it just depends. If we come sweep IRL, then we're going to IRL. Bro, if we sweep ERL, then we're going to IRL. If we're in IRL, then we're going to ERL, right? All you have to do now is to get an entry and to trade IRL to ERL and ERL to IRL, you just have to fractalize the model, right? So if you know, okay, we just swept our ERL, we just swept our previous day high, we're now going to go to IRL. You want to find IRL, line it up with standard deviation and things like that, which I'll go over in a second. And then you fractalize the model and put your side on the same bias and align yourself, okay? These are the main two truths of market. I watched a video from Flux Trades, and he was actually talking about truths of market, and it actually kind of like, I don't know, it was like, I'm also do a video on this because it's very, very beneficial. The third and final truth is market maker models, which is basically just that in order for the market to go to sell side and buy side, it must put in a model. So we're not just going to like, let me just find a day. So like here, okay, this is a pretty good example of ERL to IRL because we have, IRL to ERL because we have all this IRL. We come down, we sweep the previous day low. We actually aren't in equilibrium, which is why I didn't take this trade, but just for the sake of it, let's pretend we're in equilibrium. Let's just say, okay, we're in equilibrium, which we're not, right? But just for this example really quick. So for us to be bullish for this market maker model, right, which is just this side of the curve, what is it at? Where's that look? Is it this? Oh, nice. So when market is trading out of IRL bullish, we're targeting buy side, right? For us to be trading buy side, we must be constantly putting in models to push us higher. So every time you see us place a low, it must be fulfilling a model, meaning it must be having a liquidity sweep in a PD array and that will be an established low. Knowing that the market has to put in models for us to go from to buy side or sell side kind of gives you an edge, because like we're not going to just we're not just going to continue climbing higher with no entry. Like there'll always be a place to enter off of, because market needs that for us to push higher. Okay. And the thing about that is when you just put these things together. So when okay, we're in IRL, we must be going to ERL, right? Shit, what did I click on accident? Oh, why did I do that? When you know that we're here, we fulfilled IRL, we put in a fractalized model, because you know how market maker models work, we're now going to go to buy side. You know that the candle, whatever next candle it is, whether it's the next week or next 4-hour candle or next daily candle, needs to go open, low, high, close for us to achieve sweeping buy side and ERL. When you're able to know all of these different truths of the market, then it's so much easier for you to understand where the market is going. Okay, because one of the biggest issues is traders don't know where the market is going to go. You can't know where the market is going to know if you don't understand the market. And you need to understand that the market trades off of truths. It trades off of established functioning and algorithms that it's not just going to switch up on. Okay, these are things that are going to constantly and always be present and work in the market. It's the same as understanding price functioning and candle functionings, right? It's like when okay, because the last candle swept the high, the next candle is functioned to sweep the high unless there's a change in state. So if we're not getting any type of change in state, if we keep rejecting off of every bullish gap, or I guess respecting every bullish gap, respecting every order block, we're not going to just switch on it, right? So here, for example, this Tuesday, right? Today, or well, because it's past 3, we're now in Tuesday. So because we have this fat SMT with Friday, because ES has not swept previous week high, because we have this fat SMT. If Tuesday were to still target Monday high, we would not get a change in state to the downside like we have. So if Tuesday, which is function to go for Monday high, because we had this change in state on the hour, we know that we're not holding that same function. Otherwise, price would just keep wicking through and then going into market open, we'd open and rip, right? Because we understand price functioning, because we understand all these truths of the market, because we understand where the market wants to go, it is so much easier to just implement your model and get on the correct side of where the market's going to go. Other than that, all it really takes is just experience and seeing this happen over and over and over again, right? Like I would say, like I could go over examples, but it's like I don't need to, because prices here, what do? We dump into an IRL, right? This bullish gap, and then where do we go from there? ERL, right? This is a sell side market maker model. This is a buy side market maker model. It's nothing like if you look at this candle, this is a Tuesday. We open, put a high in, put a low in, and then Tuesday's here. So we open, put a low in. Is this part? Yeah, it's part of Monday. So we open here, right? And this is just something that eventually you just spot. We open, put a low in, put a high in, we close, right? It's this same understanding. It's this candle formation constantly, right? We we open, put a high in, put a low in, close. It's this, it just constantly happens because that's just how the market works, right? When you then pair this with, okay, at this high, we're getting a previous week liquidity or previous day liquidity sweep. We're then getting our change in state to the downside. We're fulfilled standard deviation, which is our PD array in this case. We need a target IRL. then you know market is going to sell off. And then you can just fractalize the model, find an internal liquidity sweep, internal PD array, this, that, and third, and then catch the move. It's simple. For the second group are these three confluences, which I also use in, aside of just liquidity sweep, order blocks, fair value gaps, breaker blocks, change states. I also use these three confluences, which is the first thing is standard deviation. What I noticed is, actually, I'm not even gonna say that, because I was gonna say like what I noticed is a lot of traders use standard deviation incorrectly, but realistically, there's only one way to use it. Okay, what standard deviation is when you have a change in state. So, for example, how I caught my shorts on Friday, right? When you have your change in state level, and the way that, bro, why does it keep doing that? See, now I just got thrown off. Friday. What the fuck am I looking for now? Wednesday. Okay, here. So all standard deviation is it gives you like levels or an understanding of where market is going to go after it does something. And what I mean by that is off of market's expansion move or manipulation move. Okay? So, first of all, right here, we had this bearish order block. Why? Because it's an up close candle before we sweep sell side. Why is it important to you? Like, you shouldn't be pulling standard deviation on every change in state level. You have to use it on the ones that cause market to move. Okay? So because we're having this sell-off later, there's two things about this, right? One, Friday's function is to sweep Thursday high. So what move causes that? The move where we get a liquidity sweep. We get a liquidity sweep in a bullish PD array, this down close candle, before this up move to sweep this high as our order block, right? We're in equilibrium and we're getting this internal liquidity sweep. So once we close through this up close candle before the down move, we're getting a change in state. This is where you use standard deviation to see, one, where market is going to pull into, which you can use as your TP levels, your take profit levels, or because now we know we're already taking out our day's objective going into, before even the morning session. We know there's going to be a volume injection in the morning, right? And this is what I mean, you have to use it correctly. So because we know there's going to be a volume injection in the morning, that means if we're already up here, if we're already completed our daily objective before even getting the volume injection, we're gonna enter a new phase of price, meaning we're gonna go from ERL to IRL. So not only can you take TP here, but you can also think to enter here. Why? Because standard deviation levels act as a PD array. Okay. This 2.5 level is probably the most important level in standard deviation, is generally the only one I use for the most part. Sometimes I use the 4th level, but I mostly use the 2.5 level. So once we trade into this standard deviation level, this means that this model right here has been completed. Why is that important? That's important because that means price is now going to need a new model. It's going to enter a new cycle of price. Okay? Can I skip this damn ad? So that means we're not going to continue just ripping from here, because we already completed our standard deviation level. Otherwise, we could continue climbing and it would be like if you're here, bro, why the fuck? So if we're here and you get like a kind of bearish, like you get like a 3-minute change in state, you're not going to expect us to dump, right? Because we haven't completed this model prior. Once we complete this model prior, now we can enter a new model. That's when you start looking for a new model. until we fulfill standard deviation, you should not be looking to take a new model. And why this is important, right, is on this monthly model, right, from September, we coincidentally fulfilled standard deviation perfectly on Monday and then had a huge sell-off going into the new month. I'm not going into new month, but like our biggest sell-off in the month so far. Like not even FOMC had this big of a sell-off, right? FOMC was 400 points. This was 600 points. So let's just say you had limit orders set here just because you knew, right? I mean, I saw it, which is why I caught some shorts and stuff like that. I use this as my PD array because we're already at all-time highs. There's no bearish gap to trade off of. So what you can do is use standard deviation to trade off of, because you know we're now going to need a new cycle of price before we put in another model, right? So here I have, why do I have standard deviation right here? Oh, I had it from Friday. So from Friday's bearishness, I had 2.5 marked out in case we pulled into it. Then I know that this bearish model is completed. We can now be bullish, but all we pulled into is our fucking first level and then ripped from there. But it is what it is. But the main point of standard deviation is you can use it to know, one, where your TP is going to go to, which is basically how I traded this morning, right? Off this morning's 1 minute change in state level after an SMT. Again, watch my last video that's being uploaded right now. I had my TP set. Where is it actually? Right there. I had my TP set at 2.5 and a couple at 4. As you can see, price pulls perfectly into those levels and then reacts from them. So when you can align your bias, align your models, align all these things with standard deviation, you get really nice levels where price will react from. Everything is just, what you have to understand, you just have to react the way market reacts, which means there are certain levels, certain confluences, certain price ranges that the market will react off of, right? And move a certain amount of points based off of the importance of it. It will move a certain amount of points from that level, and that's what you want to catch, right? At the end of the day, it's about catching points and ticks, right? That's all trading is. So when you're able to catch the correct levels where price will react influentially from, right? Like this level right here. This level right here was a very influential level, right? Because look at how we ripped from there. This level right here was a very influential level because look how we dumped from there, right? So when you're able to align yourself with these things, it makes trading a lot easier. It's actually crazy to see that we're up 2,000 points in a month. Holy fuck, I sold. Anyways, the next confluence, and this is also something I recently learned. It's called a PSP SMT. So what that means is you guys already know what an SMT is, right? When one correlated asset will sweep a liquidity while the other won't. So for example, right now, as you can see right here, this is Monday. NQ has swept previous week, Friday high. ES has not. Right? ES has not. So that's an SMT. What a PSP SMT is when a candle will close differently. So for example, if this Friday candle closed bearish, right? If this Friday candle, oh damn, I didn't even see that SMT that we had here. Damn, we're SMTing hella again. That's unfortunate. If this candle closed bullish, we'd have a two-stage SMT. So we have this SMT right here, right? Because NQ came down and swept Thursday low in this PD array. Right? You can see it came down, swept this low in this PD array. But if this Friday candle also closed bullish, while this Friday candle closes bearish, then that's a PSP SMT, because that means that ES is printing bullish off of this, while NQ manipulated and is then gonna get bullish after that, right? What I meant was if ES printed bullish, then that's another sign. Like it strengthens the sign of, okay, we're having miscorrelation and we want to be bullish because we're having a SMT at sell side in a bullish PD array, and one daily candle is printing bullish while one is printing bearish, right? So it's just the second stage of an SMT, and this can just give you more conviction that if we're getting this, we're most likely, or we will be getting that bullish printing after that. The final bro, why do I keep doing that? The final confluence I use is consequent encroachment. And this is very important because it just gives you a much better understanding of the markets. This can be used in multiple ways, right? The main way I use it is from wicks, but you can also use it off of PD arrays, right? And all consequent encroachment is 50% of a PD array. So like this, damn, perfect example of consequent encroachment. Actually, perfect example. So this wick we pulled into consequent encroachment of this bullish gap, which means we perfectly respected the upper half. Which means if we're not closing through the upper half, we're staying bullish. We're holding this and we're respecting it. It's a good sign. Okay. The way you can use this is, for example, there's also very there's another very good example of this recently. Yeah, right here. So if you know, right, this is how you can catch the bottom or the top of the expansion candle after a model gets put in. So if you know right here, Thursday came down, fulfilled equilibrium of the previous week high and previous week low range. We pulled into this order block right here. So you know, okay, Thursday is our model day. If we then go to the 1 hour, actually, hold on. This shit's too messy. Oh my fucking god, stop doing that. Damn, price has actually just been insanely bullish. I'm about to just full pour every bearish day now. Just kidding. Oh shit. So we know Thursday is our model day, and it's leaving a huge wick, right? So as I said, you can do this with Peter rays or wicks. I do this for wicks. So we see this huge wick, and it's an established low, right? That means for the next days to be our expansion, we want to hold the upper half of this wick. So let's say we go to the 1 hour, we see, there's no like bullish fair value gap or anything clear. We can use consequent encroachment of this wick as our PD array, right? So if we pull into consequent encroachment and we hold it, we respect it, and we start getting a change in state back to the upside. So for example, even lower, right? So here we're up here Friday, we pull down into consequent encroachment, we sweep all our session lows, right? We swept all session lows, we had that liquidity sweep. We're holding consequent encroachment. We're not disrespecting it, because if we were to disrespect it and we're wicking here, we're most likely going for that low. But because we're holding it, now all we wait for is a change in state, which we get, and now we can take longs from there, right? And if you're very confident, right, and this kind of goes for everything, but if you're very confident, okay, Thursday was our model day, we see this huge wick, we're confident we're gonna pull into consequent encroachment, you can just set your limit orders at consequent encroachment and it will work. For the most part, there's been multiple days where I set my limit orders at consequent encroachment after a day has been placed where we have like a previous day high or low sweep, we tap into a PD array, I then pull consequent encroachment of the wick that it left, and market will tap into that, respect it, and then expand the opposite way that is aligned with where the model wants us to go. Okay, so all consequent encroachment is 50% of a PD array, right? Wicks count as a PD array, okay? Because there's a lot of IRL, there's a lot of liquidity in a wick, and you can use that as your PD array. Just as all these things are just basically PD arrays, right? PD array is just a general term of something that price reacts off of to be put on its bias. So standard deviation you can use as a PD array. CE of a wick you can use as a PD array. CE of a fair value gap you can use as a PD array because it gives you a more accurate understanding of where market is going to go into, respect or react off of, and then which way it's going to trade, whether it's to sell side or buy side or side, buy side or sell side. Other than that, there's not much more to say, right? These three are pretty simple but very critical and crucial confluences that can also be used aside from just the regular, fair value gap, order block, liquidity sweep, SMT, change in state, things like that. If you also add using standard deviation, so if one day we traded bullish and that model has been completed, or like we've been distributing for 2 days, right? For example, we've been distributing for 2 days. So we had this model up here this day. We've been distributing for 2 days. We pull standard deviation from whatever high time frame model happened here that aligns with, like, let's say 2.5 was pulled out to here. Then we can know that once we pull into 2.5 right here, market will react. And if we are also putting in a bullish model, bullish PD array, sell side previous day liquidity sweep, things like that, then we know that this level one will react off of it, and it can be our modeled low or modeled high, whichever way we're trading based off high time frame bias, right? But it gives you another level of conviction based off of understanding how its confluence works. Same with a PSP SMT. All it is, it should give you more confidence and conviction in, okay, we SMT'd once, we're also getting a candle SMT basically. This should give you more confidence and conviction that, okay, price is now going to respect this and trade the opposite way. Same with consequent encroachment. If we're holding consequent encroachment of a modeled wick, then you should know that, okay, the day that is holding that we're going to expand according to the correct bias. All these things are stacking conviction, right? That's the only way you can succeed in these markets is by understanding it, which is what this is for. Candle formations, IRL to ERL market maker models. This allows you to understand the market and where price is going to go. And this, on top of the fractalized model, which you guys already know and have, gives you confidence and conviction to trade towards where these three truths are telling you market is going to go, right? That's the only true way to succeed. You need to know where the market is going to go, and you must have the conviction that the market is going to go there. Then you just trade the fractalized model and you make money. It's simple as that. Other than that, I really don't have much more to say. I hope you guys enjoyed the video. Like and subscribe if you guys are new. Comment any questions if you have any. I probably will be dropping another fundamentals video maybe in like a week or so. Trade recaps will be coming out most likely daily. Price has been pretty volatile. I'm already damn, I really did wish I caught these shorts. I literally said this in my trading group chat with my boys that we're gonna open and just shit the bed because we have a previous day high SMT and a 1 hour change in state. I had limit orders set at this change in state level, but price instead just tapped in this bearish gap with a 1 hour at liquidity sweep, and now we're absolutely shitting the bed. But this is good. Monday low is definitely gonna be the target because we don't even have a wick there. So hopefully we don't shit the bed until can kind of chop around a little bit, and then market open will have us dump. But I do want a nice swing. Hopefully going to Wednesday, if we can, sweep Friday low in this weekly PD array. Like if we can pull down into here, fuck this. Honestly, if we can pull down into here, I will be taking a nice little swing from there. So, expect trade recaps. Probably 2 or 3, maybe honestly 4. I might trade every single day. I don't know. We'll see. But I hope you guys enjoyed the video. I hope you guys enjoyed my last video as well. Trade recap for today and Friday. Other than that, I'll see you guys soon. And then, yeah, peace.